Hey everybody, it's Daniel here from InfoVest. Hope you're all doing well. So question for you, is the stock market going to crash or not at all? We look at the equity indices, we see S&P 500, we see NASDAQ make all-time highs, breaking above the 20K level. We see Nvidia making all-time highs, surpassing Microsoft now as the world's biggest company out there. We hear about in the news that there's a fund out there pouring in billions of dollars at these prices, buying Nvidia and pushing prices higher and higher and higher. And when you look at it, people often, especially the bears, come out and they talk about that, hey, this looks like just like 1999. Is it true that this looks like 1999? Are we going to see a plunge, just like in the dot-com bubble, where we saw a massive plunge in 2000 and onwards in the equity indices, where people were just buying internet stocks? As long as you had the dot-com in your name, the stock went up, right? You could buy any stock during that time that had dot-com or internet related, and you would make a lot of money. And yes, there's a lot of monies to be made during a bubble. When you look at Nvidia, every time there is a dip, it tends to get bought up and we see it moving up higher. Just look at the chart. It's done quite well. Now the question is, can we say that we are in that territory where we're in a bubble and we're going to see a massive crash or a plunge all of a sudden? Or are there some indicators out there that we can argue against that and say that, no, it's probably not going to crash anytime soon? Well, no one really has a crystal ball and no one really knows if we're going to see a crash tomorrow or not. No one knows, no one can really predict when this black swan event is going to occur. That's why it's a black swan event, right? We will know once it comes. We will know when the recession started after the recession has occurred, right? We always know later. But are there signs? Sure. I mean, if you look at this channel, I talk about all the signs of weakness in the economy. Many economies. You can look at Canada, you can look at Europe, right? I also talk about the US. Many of these areas which, if you look at the data, the growth data, yes, there are signs of weakness in its growth. But why hasn't the stock market shown signs of weakness? Why is it still resilient? Why is it moving up higher? Again, you could argue that the economy is still fine and nothing's going to crash and we got rate cuts. Well, yes. If you look at this last CPI inflation report, that caused equities to go up higher. If you look at the talks about rate cuts, well, you might argue now it may not be a good thing, but before there was talks about 3 rate cuts. That has now changed to 1. That should be negative for the equity markets, but 3 rate cuts, the idea of 3 rate cuts that the Fed told us, that was creating the markets, this euphoria in the markets that, hey, rate cuts are coming, things are going to be fine, and this is a soft landing, we're going to go higher. But I have a different take on the stock market and why it's moving up higher. And I believe that the stock market's not going to crash until every single one of you are massively long and you stop talking about this recession. And that's the truth about, many, if you look at past of many recessions, that's the truth when you look at, let's say, 2006, 2007, you look at the dot-com bubble and so on, right? You see this blow off top, you see this euphoric rally, even though we know there are signs, negative signs, right? Like, for example, the housing market back in 2008, everyone knew before that the property markets were going crazy. There's a bubble, but it didn't crash until late 2008. And it happened to be during elections time. Same thing in 2000. Didn't happen late until 2000 where we had the crash, and certain events occur as well that cause these stocks to really plunge, the internet stocks out there, right? So it takes an event, something to trigger this plunge. And let's not forget, during that time, let's go back to 2007, 2008, right? We started to get rate cuts and we didn't see a massive plunge. It happened slowly, the rate cuts. And we had some of the prices come down a bit, but it wasn't where there was panic on the street. It was until later there was panic, and then you had the emergency rate cuts come in. It looks kind of similar in the sense that we're talking about rate cuts. We have a lot of countries out there like Canada, Europe, right? The European Central Bank out there talking about cutting rates, and actually already have cut rates, and they've already started the rate cut cycle. Everyone's just waiting for the US, the Federal Reserve, to cut rates, to start their rate cut cycle. And once they start to cut, that can also fuel more steam into the equity markets. But it's not going to plunge until all of you think that it's okay. So you might need a couple of rate cuts first in the beginning and see, okay, the markets are going up. I'm missing out on NASDAQ at 20,000, S&P 500 on 5,500, the QQQs, the SPYs going up higher and higher, NVIDIA is going higher. Okay, I got to invest now. And to prove this, you can look at the Commitment of Traders report. You can look at the positioning in the reports out there. The people who are long, and actually not aggressively long, but quite a few of them, are the small speculators out there, the retail. They're buying, and they're mostly long. When you look at the institutional side of things, the large speculators, they're actually short. They're not long, they're short. And if you look at just 1-2 days back, just look at the chart of NASDAQ, right? Just look at the chart of QQQ, and you see a big green candle, right? Couple of green candles moving up higher. And moving up higher into where? Into all-time highs. And you get these aggressive moves up. What is that? I could argue that those are probably stop losses getting hit for people who are trying to short this and say, okay, this thing's going to crash. Those stop losses getting hit, causing those cover, if you're short, you got to cover your position. How do you cover your position? You buy it back, causing that massive squeeze into that 20K level of all-time highs. Again, you can argue that, okay, the NVIDIA, story that came out, that there's a fund going out there buying billions of dollars. Sure, but forget about that for a second. Look at the positioning. You have institutions out there that are mostly in cash. They're not really long stocks. Actually, they're more on the short side of things, if you look at the CTAs. And I'm talking about here again the Commitment of Traders report. And if you look at what are they doing with bonds, they're actually most of them are short bonds. So can we still see the equity markets move up higher and higher? Sure, if the positioning continues to be where people still think there's going to be a crash around the corner, something crazy is going to happen, and we're going to get a massive plunge, and that therefore I'm sitting on the sidelines holding cash and I'm not investing, then forget about it. The markets are not going to turn around. Or let me say this, it's going to be harder for the markets to turn around. It can still happen, don't get me wrong, it can still happen. You can have a black swan event and then, the equity markets to plunge. Sure, it's not hard and fast rule that, you have to, it's only the positioning that's going to dictate where the markets go, although it is important. But sure, you can get something that occurs in some event that causes the markets to completely turn around and plunge. But you're not going to get it if everything is fine, if everything is okay, nothing too crazy is happening, and you have people sitting on the sidelines. In fact, if that's the case, especially institutions, big money is sitting on the sidelines, and the equity markets keep moving up, the clients are going to come to the institutions and say, hey, what are you doing? We're missing out on this, on all this action. The markets are going up. The Fed, eventually they're going to cut rates. They penciled in one rate cut. That can definitely change. There's another topic on that, which I'll just leave for another time. But they penciled in one rate cut, and then eventually when they start cutting rates, they're going to start their rate cut cycle. And the clients are going to say that, okay, look, inflation's coming down. Growth data is still doing okay. It's not that bad. I mean, there is weakness, but in the US, it's doing fine. What are you doing? Keeping money on the side. Invest, invest. We need to grow our portfolio. We're missing out on these returns. And then when you get that FOMO coming into the markets and you get the positioning where people start to go more long, then I would think, only then, you can get a situation or scenario where you get a turnaround. Can we still get a plunge, let's say next week, this week? Sure, you can get a pullback. We've been moving up higher. You can get, 2 to 5% kind of pullback. Let's say maybe even 10%, and then reverse all the way back up. We also got other events coming up, like the elections. That's going to bring in more volatility into the markets, right? You can get a plunge there, and then once that's out of the way, then what, right? What else to look for? Back to rate cuts, back to where's these cuts, when these cuts are coming, back to looking at the economic data, back to looking at inflation. If inflation continues to come down lower and the economic data looks it's still fine, and you're getting rate cuts, then that will be all positive for the equity markets. And then again, positioning, commitment of traders report. If you're sitting on the sidelines looking at this, you're like, okay, screw it. Come January next year, you're like, okay, it's time to now create a portfolio, rebalance, make some sales in December, keep some cash there, and then time to rebalance for the new year, for the next year, and time to go long because looks like things are okay. But just like in 2007, we do know commercial real estate, and we've heard from many banks out there come out saying that it has the plunge or the disaster has just started. So again, it's just starting, it's taking time, the lags are also taking time. People are sitting on the sidelines, NASDAQ's moving up higher. You do have this temporary blip like the elections that could shake things up, but you're going to have to wait until maybe a pullback and maybe until the elections are passed, and then for people to then realize that, okay, we gotta FOMO in, we gotta invest, and let's ride the train. And then when everyone is long, then you can say, okay, now you want to be fearful. When everyone's greedy, you want to be fearful. When everyone's fearful, that's when you want to be greedy. Who said that? Warren Buffett, right? So same thing. When you look at the positioning, when you're looking at the stock market and all of that, the positioning is showing that people are still fearful. Maybe not the small speculators, but the large speculators out there. They're not really massively long, and that's what would create the catalyst for a plunge if everyone's massively long. I feel that would be the perfect puzzle in this piece. Now, the other perfect puzzle that I haven't mentioned was the Federal Reserve. Does the Fed cut once? Does the Fed not cut at all and really screw things up? Causes the economic data to really further deteriorate. What about in that scenario, right? There's so many scenarios I could play out here, but if you get the Fed not cutting enough or on time, or they continue to be hawkish for longer, well, just look at the data. It's showing deterioration. You look at the neighboring countries of US, you've already seen a lot of countries are in trouble. And then eventually that will also cascade into the US, and then eventually you might get those emergency rate cuts sooner or later. So a lot to think about, a lot to contemplate about, but the main thing I wanted to just leave off and really pinpoint again in this video is the commitment of traders report showing that big speculators, large speculators, are not massively long. It's really the only small speculators like the retailers who are long. I still wouldn't say massively long, but they're long. And this money that's sitting on the sidelines in cash, waiting for an opportunity, what could that be? Could it be just a 5% dip, 10% dip? I don't know. I mean, we've had many dips in the past, a little bit, right? But I feel that's not enough for a move downwards to happen. I feel in terms of the positioning, we need more people to go massively long in order for the reverse trade to happen, the plunge that everyone's talking about. We need to hear less about this recession and crash in order for the plunge to happen. And generally in past, this is how the markets generally work, is that when everyone's long, that's when things go haywire. When everyone's short and bearish, that's when things actually go the opposite way. That's how it is. Don't believe me? Take a look at the charts. Anyways, let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye.